learn about project finance. Introduction. Project finance is the financing of long-term infrastructure, industrial projects, and public services using a non-recourse or limited recourse financial structure. The debt and equity used to finance the project are paid back from the cash flow generated by the project. Project financing is a loan structure that relies primarily on the project's cash flow for repayment, with the project's assets, rights, and interests held as secondary collateral. Project finance is especially attractive to the private sector because companies can fund major projects off balance sheet, OBS. What are the key features of project financing? The salient features of project financing are listed below. Capital-intensive financing scheme. It is best suited for ventures that require large amounts of equity and debt. It is also applied in developing countries for development purposes. However, it is more expensive than corporate finance and increases costs while reducing liquidity. Risk allocation. Risks associated with the project are shifted onto the lender. Thus, sponsors prefer this scheme as it helps them mitigate risks. However, lenders do receive a better credit margin with project finance. Multiple participants. Since project financing deals with large-scale projects, numerous parties can be allocated to handle various aspects. Asset ownership. An SPV is relied upon to oversee the project and monitor the assets. After the project is complete, the project's ownership is given to the concerned entity as decided by the terms of the loan. Limited recourse solution. With project financing, the borrowers do not have ownership of the project till completion. Thus, the lenders do not have to waste time evaluating the assets of the borrower. Instead, they can focus on the feasibility of the project. Thus, the financial company can opt for limited recourse from the sponsors if it deems that the project might not generate sufficient cash flow to repay the loan. Loan repayment with cash flow. As per the terms of the loan, the excess cash flow should be used to pay off the outstanding debt received by the borrower. Over time, this reduces the risk exposure of the financial services company. Improved tax treatment. Under the scheme offered, the project and/or sponsors can avail of better tax treatment. Credit impact. Project finance ensures that the credit of the sponsor has no impact on the project. Thus, the credit risk of the project is better than the credit standing of the sponsor. Non-recourse financing. When a company defaults on a loan, recourse financing gives lenders full claim to shareholders, assets or cash flow. In contrast, project financing designates the project company as a limited liability SPV. The lender's recourse is thus limited primarily or entirely to the project's assets, including completion and performance guarantees and bonds, in case the project company defaults. A key issue in non-recourse financing is whether circumstances may arise in which the lenders have recourse to some or all of the shareholders' assets. A deliberate breach on the part of the shareholders may give the lender recourse to assets. Recourse vs. non-recourse loan. If two people are looking to purchase large assets, such as a home, and one receives a recourse loan and the other a non-recourse loan, the actions the financial institution can take against each borrower are different. In both cases, the homes may be used as collateral, meaning they can be seized should either borrower default. To recoup costs when the borrowers default, the financial institutions can attempt to sell the homes and use the sale price to pay down the associated debt. If the properties sell for less than the amount owed, the financial institution can pursue only the debtor with the recourse loan. The debtor with the non-recourse loan cannot be pursued for any additional payment beyond the seizure of the asset. Key takeaways. Project finance involves the public funding of infrastructure and other long-term, capital-intensive projects. This often utilizes a non-recourse or limited recourse financial structure. A debtor with a non-recourse loan cannot be pursued for any additional payment beyond the seizure of the asset. Project debt is typically held in a sufficient minority subsidiary not consolidated on the balance sheet of the respective shareholders, i.e., it is an off-balance sheet item. Thank you for learning from options and ideas.